Hello, guys. Welcome back to Stacking Stocks, and thanks for joining us today. We're going to talk about bull and legendary long-term investor Ron Barron's take on Tesla stock. What's in the pipeline for the giant EV maker? Let's hit the ground running. Ron Barron explains several key aspects of Tesla's business and why the company's stock is worth holding for a very long time. He also shared what he believes are the biggest short-term risks being faced by Musk's companies currently. Barron's namesake investment firm, Barron Capital, is among Tesla's biggest long-term shareholders. The firm currently holds almost 6 million Tesla shares on a cost of ownership basis at $42.88 each. According to the investor, Barron Capital has made its clients about $54 billion in profits, and from that amount, about $6 billion was from the firm's $380 million investment in Tesla stock years ago. Ron Barron speaks highly of Tesla CEO Elon Musk. In a recent interview, Barron was full of praises for Musk. Well, it's so hard to accomplish what he has, and then when you read about how he's treating people and the social betterment he's creating for humanity, there wouldn't be electric cars if it weren't for Elon Musk. In fact, you probably won't be into space the way you are right now were it not for Elon Musk. This guy is dedicating himself to making the planet and humanity able to survive. So Elon Musk has done a lot so far for people as well as the planet. We understand why Ron Barron praises the EV maker that much. But there's also something else we gathered from Barron's recent interview. The legendary investor was asked what he believes is currently the biggest risk that Elon Musk and his companies are facing. According to Barron, Musk's health is Tesla and SpaceX's most significant short-term risk, simply because the CEO tends to work extremely hard. This was understandable considering Musk's goals, but his health could be a factor that could adversely affect Tesla and SpaceX if it were to take a hit. As much as he's healthy right now, Elon Musk deprives himself of sleep. He works. He sleeps 5 hours a day. He works 19 hours a day. What he's doing is unbelievable, so short term, that's the risk. Earlier this year, Barron predicted that Tesla shares would reach $2,000 per share over the next 10 years. And it would be about $1,500 per share by 2024. Barron does take profit from his Tesla investment from time to time, such as when he sold 1.8 million shares earlier this year in a move that he called painful but essential for risk mitigation. Tesla's stock has indeed come a long way since its inauguration in May 2010, and many investors have faith in the company's CEO, Elon Musk. Ron Barron is just a legendary investor voicing out what many investors have in their thoughts. However, the risk factors involved also go beyond Musk's health. The price of a share mainly depends on the attitude of the investors to the issuing company. Among the most important factors that will influence a stock's price are expectations about the company's results. The demand for Tesla shares on the stock exchange depends on the analyst's predictions about the company's profit or loss. A company can also increase its value in the market through the assets it owns. Just think of, for example, a patent, a real estate portfolio, a sales exclusivity. Innovation also plays an important role in the success of a company. So there's just a lot involved when it comes to risk factors. Stock market predictions and prices are also influenced by the level and expected evolution of interest rates. After all, at low interest rates, investors will dare to take more risks to obtain higher returns and find their way to the stock exchange more easily. The sector in which a company operates is also a factor that can cause its price to fluctuate. A healthy company in a sector that's in difficulty will be negatively impacted by the image of the sector on the market. We're thinking here of the financial values that have become much less credible after the crisis in 2008. And the value of Tesla shares on the stock exchange can also rise or fall due to a radical change that the sector is experiencing. A new product that's released or new habits that consumers adopt are factors that can determine the evolution of a share's value. Another great opportunity is the consolidation of a sector. A company that acquires other companies in the same sector can establish itself as a market leader and occupy a dominant position there. While Tesla is the leading company in the EV making industry currently, it remains to be seen whether this will still be the case in the coming years in a market where many other brands are also strongly producing their own EVs. One thing is certain, electric cars are the future and a fast-growing segment of car sales. In a broader context, the general evolution of the markets can increase or decrease the value of a security. In gloomy markets, as we have known them during the financial crises of 2008 and 2011, Even healthy and promising values were sucked into a downward spiral when there was fundamentally nothing wrong with them. In periods of euphoria, the entire market takes part in the increase without being economically justified. Major economic and political trends can also trigger panic or calm on the stock market and sweep an entire market up or down due to favorable or troubling macroeconomic fundamental occurrences. A country's fiscal, budgetary, and especially monetary measures are more likely to reassure or worry investors. Now, take a look at the Chinese stocks recently. With the numerous regulations being introduced by the government, tech firms are set to be the most affected. However, there's doubt whether the Chinese government would want to hurt its local EV making companies. Consumer habits can also play a role in the potential evolution of a stock price, as with the Tesla stock prediction. Some opportunities are cyclical. Certain sectors that have had to implement restructuring can get out of a cycle of less growth due to more consolidation. Other opportunities are more structural. This is the case, for example, for companies active in education. As emerging countries transition from a predominantly agricultural culture to an industrial and service economy, there's a structural need to improve the educational system. There may then be a strong demand for these companies on the stock exchange. Some companies are also more sensitive than others to the evolution of the currency. A company that derives a large part of its turnover from exports will experience a rise or fall in the currencies on its turnover, profitability, and stock market price. As we can see, the stock market price will therefore depend on internal factors, which is balance sheet structure, profitability, earnings expectations, the share of turnover in exports, capacity to innovate, position in the market relative to competitors, and assets. But this evolution will also depend on external factors, the political and macroeconomic situation, as well as the evolution and the perception of the sector in which the company operates. All these factors must therefore be correctly approached and analyzed by the investor. But Tesla seems to have traversed most of these risk factors. That could be why Ron Barron believes that the only short-term risk is Elon Musk's health. While the entire world suffered from the economic effects of COVID-19, Tesla reported a sharp 71% increase in vehicle production in the fourth quarter compared to the same quarter last year. Most people thought Tesla's goal of producing 500,000 vehicles by 2020 was nearly impossible. But the California car maker almost managed to reach its target by producing 499,647 cars by 2020. The shares also reached an all-time high on November 4, 2021, when the closing price was $1,229.91. And the company keeps doing everything possible to push its stock price. For example, Tesla plans to grow aggressively, expanding deliveries by more than 50% each year over a multi-year horizon. Production facilities in Berlin and Texas expected to be open by the end of 2021 or at the beginning of 2022. They're likely to boost near-term growth. There's so much to look forward to with this EV car maker. Well, that's all that we have for you today. Drop your opinions in the comments section. Don't forget to like, share, and subscribe. Thanks for watching, and we'll see you next time right here on Stacking Stocks.